Capital. Great to see you again, sir. Last we spoke in the fall, you said you guys were maximum bullish. So when did you change that, and what does that mean exactly for your investment philosophy at this point?
Thanks for having me again. We got really super bullish around the middle of November, and we stayed that way pretty much right until the date that you just mentioned, March 20th, which is the first day of spring and my son's birthday, so I remember it so easily.
Right.
But on March 20th, we began to pare back equity holdings. We cut them in half, and then recently we started hedging what was left, shorting the Russell 2000. So I don't think the bull market is over. I want to be very clear. I don't think the nail's in the coffin, and we're going down 30 or 40% right now. I just think we've come so far so fast. Doesn't mean we can't go higher, but when Wall Street strategists are literally falling over themselves to raise their targets, when the individual investor spent 5 years disavowing the whole market and now is falling over themselves to get into mutual funds, and then you've got some cracks in the pavement looking at some of the indices and the sectors, clearly this is the time for either the pause to refresh or a decent 4 to 8% pullback, and I think
Paul,
the upside is 15,000.
When you tell us ahead of time, another surge could end in ruin, those are some pretty scary words.
Yeah, so markets have, I always say, windows of opportunity, and I think here's another one. These happen all the time where there are enough cautionary signs to warrant a pause to refresh, which can be sideways action over a period of weeks or a few months, or it could be a pullback in price. When the markets ignore what it should be doing, they normally pay back in spades. So I think 15,000 is your upside max and 13.7 is your downside max in the short term, meaning the next couple of weeks to a couple of months. If the market blows off to 15,000 here, given all the worrisome signs that I see, I think it ends really, really poorly. And I liken it to 1987. I don't think we're going to have a crash in one day, but if we blow off here without pausing and gathering ourselves, it's going to end really poorly in the third quarter.
Okay, but let's work in some other asset classes. Can I ask you a question, or do you want to just keep on rolling? It's totally fine. We did invite you, but I do want to direct the conversation because, investors not only pick up stocks, but bonds as well. So if there's not a whole lot of room left, you're saying, in the stock market, and we know that the bond market, boy, this bond rally that people keep calling for to end, the bubble to burst, is not bursting, as we know, especially right with last week's yield falling so low. What do you think? Like, where should people be investing their new money?
So you look at the prospects for the next quarter, because we're in a new quarter, the next 2 quarters. And Lori, as you and I have talked about many times, I think people keep calling for the demise of this great bond bull market, and clearly we're at the end. I mean, we're in the 8th or 9th inning. But listen, treasuries have had a remarkable run over the last month. It's been almost a near vertical run. No one talks about it. I think you got to be careful, obviously, in anything you do. But I think the second half of the year, bonds deserve merit, along with, believe it or not, gold and silver. I mean, they've been decimated. The stocks, you look at the Newmonts and the Barracks, they've been decimated since last September. I think they're going to warrant a look for the second half of the year. I think the 2 halves of the year will look very, very different, with perhaps certain areas of the bond market that have not gotten the love, getting some love in the second half, and certainly the metals arena coming back into favor.
Okay, there you have it. Paul Schatz's Investment Outlook. Thank you very much.
Thanks, Lori.
And gold